Prices do not jump like this without leaving footprints. Silver just made a move that looks exciting on the surface, but underneath, it is flashing a warning sign that most people are missing. This rally is not only about rising demand, industrial use, or investor interest. It is pointing towards stress inside the financial system. It is showing where leverage is breaking. It is revealing where traders are being forced to make painful decisions. And if you understand what this really means, you will start looking at silver in a very different way. Because the recent surge in silver prices is acting like a signal flare. It is exposing hidden pressure that does not show up on price charts alone. It is connected to margin calls, collateral shortages, and forced liquidations that happen quietly behind trading screens. This is the part of the market that rarely gets explained in simple terms, yet it controls how fast prices rise and how violently they fall. While many people are celebrating the rally and talking about supply shortages or safe haven demand, a deeper story is unfolding that explains why this move happened so fast and why the reaction afterward shocked so many traders. In this video, you will learn what a margin call really is, why exchanges suddenly demand more money when prices move sharply, and how that single decision can force millions of dollars to be sold in minutes, even when the asset itself is still strong. You will understand why the drop that follows a rally is often not a sign of weakness in silver, but a sign of weakness in over-leveraged positions. You will see how leverage builds quietly during calm periods and then gets wiped out during rapid moves, creating volatility that looks confusing to normal investors. You will also learn why these margin events are not random. They appear at specific moments when risk in the system becomes too high to ignore. This is when the market starts cleaning itself by pushing out the weakest hands. This process is uncomfortable, fast, and often misunderstood. Yet it tells us more about the real state of the financial system than any headline about supply or demand. Silver is simply the messenger in this situation. It is the asset that moved enough to trigger the alarm. There is a reason why precious metals often expose stress before other markets do. They sit at the intersection of speculation, hedging, and safe haven demand. When pressure builds in the background, metals react in ways that reveal what is happening with liquidity and credit. This is why seasoned traders do not only watch the price of silver, they watch the margin requirements, the volume spikes, and the speed of reversals. These are clues that point toward hidden tension. This video will break down how a margin hike by an exchange can change the entire direction of a rally within hours. It will explain why traders who borrowed money to bet on silver suddenly have to find cash they do not have. It will show how this leads to forced selling that has nothing to do with silver losing value. It is a mechanical process driven by rules of the trading system, and once you see this pattern, you will start recognizing it in other markets too. Stocks, commodities, and even currencies go through the same cycle when leverage reaches extreme levels. What looks like a normal price correction is often a margin event in disguise. You will also discover why long-term holders of physical silver are not affected by this process in the same way as short-term traders. The difference between owning an asset and borrowing to trade it becomes very clear during these moments. One group feels panic, the other watches volatility without being forced to act. This contrast is one of the most important lessons you can take from the recent silver rally. It shows how the structure of the market matters more than the story people tell about it. Another important part you will learn is why margin calls can spread from one market into others. When traders are forced to sell silver to raise cash, they often sell other assets too. This creates waves across the financial system. A problem that starts in one corner can quickly appear somewhere else. This is how hidden stress travels, and silver once again becomes a signal that something bigger is happening. By the end of this video, you will understand why sharp rallies and sudden drops are often connected by the same cause. You will know how to read these moves as signs of leverage being built and then destroyed. You will start to see why experienced investors pay attention to the mechanics behind price action instead of only reacting to headlines. This knowledge changes how you interpret market volatility. It turns confusion into clarity. It turns fear into understanding, and it helps you make better decisions during fast market moves. Most people watch the price of silver and think the story ends there. In reality, the price is only the surface. The real story is happening in margin accounts, collateral requirements, and risk controls that operate quietly in the background. That is where the true signal lies. This video will guide you through that hidden layer in simple language so you can see what others overlook. Stay with me until the end because each part connects to the next, and the full picture only becomes clear when you see how the rally, the margin hike, and the forced selling all fit together like pieces of a puzzle. By the time we finish, you will not only understand what just happened in the silver market, you will also gain a tool for reading future market moves with a deeper level of insight. Welcome to our channel where we break down complex financial events into clear and simple explanations. And if you want more insights like this that help you see what is happening beneath the surface of the markets, make sure to subscribe and join us for the next deep dive. Silver did not climb slowly over months in this move. It accelerated in a short span of time and caught the attention of traders across the world. Prices pushed higher day after day, breaking levels that many thought would take much longer to reach. Charts that once looked calm suddenly showed steep upward lines. Volumes increased, volatility increased. Conversations around silver became louder in trading rooms, forums, and financial news. Some people called it a breakout, some called it a new bull phase, others focused on industrial demand and safe haven buying. The price kept rising and reached levels that were very close to historical highs, levels that had only been seen during rare moments in the past. This created excitement and urgency. Traders who were not in the market felt pressure to enter quickly before the move went even further. Those already in positions felt confident and increased their exposure. Momentum fed on itself. Every rise in price attracted more buying. Every new high made the rally look stronger and more convincing. Then, in a very short time, the mood shifted. The same market that moved up quickly started to fall with similar speed. The drop felt sudden to many observers. It did not come with a major news event about silver supply. It did not come with a collapse in industrial demand. It did not come with a change in the long-term story around precious metals. Instead, it followed a technical decision that most ordinary investors rarely notice. Exchanges adjusted margin requirements. This single adjustment changed the behavior of thousands of leveraged traders at once. What looked like a strong rally suddenly faced heavy selling pressure. Prices fell sharply, confusing those who only followed headlines about demand and supply. To understand why this happened, it is necessary to understand a concept that sits quietly behind most trading activity, a concept called margin. Margin is the system that allows traders to control large positions with a small amount of their own money. Instead of paying the full value of silver contracts, traders deposit a fraction of that value as collateral. This borrowed exposure lets them amplify gains when prices move in their favor. It also amplifies losses when prices move against them. A margin call happens when the value of a trader's position changes so much that the exchange requires more money to keep the position open. The trader must add cash quickly. If the trader cannot provide this cash, the position is reduced or closed automatically. This process is mechanical. It does not care about opinions, analysis, or long-term beliefs about silver. It is purely about numbers, risk, and collateral. When prices rise very fast, risk inside the system rises as well. Exchanges monitor this risk constantly. When volatility increases beyond certain limits, they raise the margin requirement to protect the stability of the market. This means traders suddenly need more money to hold the same positions they were comfortable holding just hours before. This is not a judgment on silver. It is a judgment on how much leverage is present in the system. During the silver rally, many traders were using margin to increase their exposure. As prices kept rising, their positions grew larger in value. At the same time, volatility increased because the moves were becoming sharper. From the perspective of the exchange, the market was becoming riskier. Large leverage positions combined with fast price movements create the possibility of sudden losses that can spread through the system. To prevent this, the exchange increased the margin requirement. Overnight, the amount of money needed to hold silver contracts went up. Traders who were already stretched now faced a problem. They had to find additional cash immediately. Some could add funds and keep their positions. Many could not. They were forced to sell part or all of their holdings to meet the new requirements. This selling was not a decision based on the belief that silver had lost value. It was a reaction to a rule change in the trading system. It happened quickly because margin calls come with strict time limits. Positions must be adjusted within hours, sometimes minutes. As multiple traders tried to reduce positions at the same time, selling pressure increased sharply. The market, which had been driven upward by enthusiastic buying, now faced waves of forced selling. Prices dropped fast because the selling was urgent and not sensitive to price levels. Traders under margin pressure do not wait for better prices, they sell to survive. This is why the decline looked dramatic. It was driven by mechanics, not by a shift in the fundamental story of silver. Real demand for silver in industry, investment and jewelry did not suddenly disappear. What disappeared was the ability of leveraged traders to maintain large positions under stricter margin rules. The price reacted to this forced activity. This is an important distinction. When prices fall because buyers lose interest, the move tends to be slower and more gradual. When prices fall because traders must sell immediately, the move is fast and sharp. The timing of the margin call was not random. It came after a period of rapid price acceleration and increasing volatility. Exchanges are designed to step in when risk reaches uncomfortable levels. The silver rally created exactly that situation. The faster the price moved, the more leverage built up in the system. As traders tried to take advantage of the momentum, the more leverage that built up, the more fragile the market became. When the exchange raised margins, it exposed this fragility. Traders who seemed confident during the rally suddenly faced pressure they did not expect. The selling that followed was a chain reaction. One trader selling pushed the price down, which increased losses for another trader, which triggered another margin call, which led to more selling. This feedback loop can happen very quickly in leveraged markets. From the outside, the drop looked like silver had failed. From the inside, it looked like the system was reducing risk by clearing out excessive leverage. The sell-off was a byproduct of risk management, not a statement about the value of silver. People who owned physical silver or held unleveraged positions did not face the same pressure. They could watch the volatility without being forced to act. This difference highlights how margin trading creates a layer of activity that sits on top of the real market. When that layer becomes too large, small rule changes can cause big price movements. The recent silver move is a clear example of this process in action. As the forced selling continued, price levels that looked strong during the rally were broken easily. Support levels on charts failed because the selling was not based on technical analysis. It was based on the need to raise cash. Traders under margin pressure do not look at chart patterns. They look at their account balance and the deadline to meet margin requirements. This urgency creates price action that looks irrational to those who do not understand the mechanics behind it. Once enough positions were closed and leverage was reduced, the intensity of the selling began to slow. The market started to stabilize because the immediate pressure had been released. This stabilization often confuses observers who wonder why the price stops falling even though no major news has changed. The reason is simple. The margin problem has been resolved for many traders. The mechanical selling is over and the market can return to being driven by normal buying and selling decisions. Throughout this process, the underlying demand for silver did not change dramatically. Factories still needed silver for electronics and solar panels. Investors still viewed it as a store of value. The difference was in how many traders were able to hold large leverage positions. The sell-off was the result of positions being reduced, not beliefs being changed. This is why understanding margin is essential to understanding what happened. It explains the speed, the intensity, and the timing of the drop after the rally. It shows that the price action was not random or mysterious. It followed a predictable pattern that occurs whenever leverage builds up too much in a fast-moving market. A margin call is often described as a technical rule inside trading accounts, but in reality it acts like a loud signal that the market has reached a point of stress that cannot be ignored. It tells a story about what has been building quietly before the price made its dramatic move. When margin calls appear after a strong rally, they show that leverage in the system has reached a peak. Too many traders are controlling large positions with borrowed exposure. Too many accounts are stretched to their limits. The rally did not only lift prices, it lifted risk. This risk remains hidden while prices move smoothly upward, but it becomes visible the moment exchanges adjust requirements and traders struggle to respond. The margin call exposes how crowded the trade has become and how fragile many positions really are. It reveals that the strength of the move was partly built on borrowed money rather than solid capital. This is why a margin call is more than an event. It is a signal that leverage has grown too large for the system to handle comfortably. At the same time, a margin call signals that volatility has reached a high level. Exchanges do not raise margin requirements during calm periods. They do it when price swings become fast and unpredictable. High volatility means higher risk for everyone involved in the market. The margin adjustment is a defensive step to prevent instability from spreading. When you see margin calls happening after a rally, it means the market is no longer moving in a stable way. It is moving with force and speed that makes risk controls necessary. This is important because volatility often appears near turning points or major transitions in trends. Fast moves in either direction create pressure that forces the system to react. The margin call becomes a visible sign that this pressure exists. Another message hidden inside a margin call is the cleaning out of weak positions. Traders who entered late in the rally with borrowed money are the first to feel the pressure. They are often the least prepared for sudden rule changes because they relied on momentum to continue. When margins rise, these traders cannot hold on. Their positions are reduced or closed. This process removes fragile leverage from the market. It is uncomfortable and chaotic, but it serves a purpose. It reduces the number of participants who are depending on borrowed exposure to stay in the trade. What remains after this process are stronger hands with more stable capital. This cleansing effect can change the character of the market. It can slow the pace of wild swings and create a new phase where price action becomes more sustainable. Because of this, margin calls can sometimes mark important turning points. They can appear near the end of explosive rallies when leverage is at its highest. They can also appear during sharp declines when panic selling creates extreme volatility. In both cases, they show that the market structure is under stress and that something is shifting beneath the surface. A trend may pause, reverse, or transform into a slower and more stable movement after excessive leverage is removed. Observing margin activity gives insight into where the market stands in its cycle. It is a way of reading the hidden layer of risk that is not visible on price charts alone. For investors, this understanding has practical value. Traders who use heavy leverage face the greatest danger during these moments. Their success depends not only on the direction of price, but also on the rules set by exchanges. A sudden increase in margin requirements can force them out of positions, even if they believe strongly in the asset. This means leverage adds a second layer of risk beyond normal market fluctuations. It creates a situation where traders must worry about both price movement and system rules at the same time. Many traders underestimate this risk because margin allows them to participate in large moves with small capital. They enjoy the benefits during rallies, but suffer the consequences when requirements change. In contrast, long-term holders of physical silver are not directly affected by these margin shifts. They own the asset without borrowing to control it. When price swings occur due to forced selling, They can observe without being pushed into action. Their position is not threatened by margin calls because they do not depend on borrowed exposure. This difference highlights the stability that comes with unleveraged ownership. It allows investors to think long-term instead of reacting to short-term mechanical pressure. While price volatility still affects the value of their holdings on paper, it does not force immediate decisions. Margin shifts can also calm a rally or reveal its true strength. When leverage is removed, the market may slow down and move in a more measured way. If prices hold steady after margin pressure is relieved, it suggests that real demand supports the move. If prices continue to fall even after forced selling ends, it may show that the rally depended too heavily on leverage speculation. This is why watching margin activity can help investors understand whether a move is built on strong foundations or temporary enthusiasm. The importance of margin calls extends beyond the silver market. These events often spill into other markets because traders do not operate in isolation. When they are forced to sell silver to meet margin requirements, they may also sell stocks, commodities, or other assets to raise cash quickly. This creates waves of selling across different areas of the financial system. A problem that begins in one market can appear elsewhere within hours. This is how stress travels. It moves through the need for liquidity. Traders sell whatever they can to survive margin pressure, and this affects prices far from the original source of the problem. Margin calls also reflect broader market sentiment and liquidity conditions. When many traders are using leverage at the same time, it shows a period of confidence and risk-taking. When margin calls begin to appear, it signals that this confidence has reached an extreme. The system responds by demanding more collateral, and traders respond by reducing positions. This cycle reveals how comfortable or uncomfortable the market is with risk at any given moment. It shows whether liquidity is abundant or suddenly in demand. Watching these signals provides insight into the mood of the market that cannot be captured by headlines alone. As margin pressure spreads, it can change how participants behave across the board. Traders become more cautious. Volatility may decrease after the initial shock. Because fewer leveraged positions remain, the market can enter a new phase where movements are driven more by real buying and selling rather than borrowed exposure. This shift affects everyone, not just those trading silver. It influences how capital flows through the financial system and how quickly prices move in different assets. Understanding margin calls as signals rather than isolated events changes how investors interpret sharp moves. Instead of seeing only chaos, they can see the process of risk being reduced. Instead of assuming that price drops mean fundamentals have changed, they can recognize the role of mechanical selling. This awareness helps investors stay calm during volatile periods and avoid reacting emotionally to fast price swings. It provides a clearer view of what is happening beneath the surface and why the market behaves the way it does during intense moments of stress. What looked like a powerful bullish move in silver was also a window into hidden pressure inside the market. The rally did more than lift prices. It exposed how much leverage had built up beneath the surface. It showed how quickly risk can rise when traders depend on borrowed positions. And it revealed how a simple margin change can flip excitement into forced selling within hours. This is the deeper story behind the move that many people never see. The key lesson is simple. The next time silver makes a big move, do not only watch the price, watch the margins, watch how exchanges react, watch how traders are forced to respond, because that is where the real signal lives. That is where you can see whether a move is built on strength or on fragile leverage. If this breakdown helped you see the market in a new way, make sure to subscribe to the channel for more simple and powerful insights like this. Like the video, share it with others who follow silver in the markets, and stay with us as we continue to uncover what is really happening beneath the surface.